DeepSeek didn't just rattle markets. It exposed the real engine under your financial life, and it isn't innovation, it's leverage. One night, investors watched more than $1 trillion of value evaporate, while the people who pay real bills were still losing ground to rent, groceries, and AI layoffs. And here is the part nobody wants to say out loud: the system did not break. It followed a script. This is not financial advice, this is financial education. In 2026, you are surrounded by numbers that look calm on television and feel brutal in your bank account. Inflation may have stabilized on paper, but your purchasing power is still damaged. Housing costs didn't just rise, they permanently detached from wages. And while you're trying to survive, the global financial system keeps transferring wealth upward with machine-like efficiency. Today, we are going to talk about the modern AI bubble theater, why a Chinese AI model became a trigger for Wall Street's biggest companies to adjust their narrative in public, and what that tells you about where money actually goes when the market moves. By the end, you will understand why the stock market can fall and still not mean you win, and why the next rally can be the calm before another quiet transfer of your future. Let's start with the headline version, because you already felt it. In the middle of the AI boom, a single news cycle around a new model from China hit the US technology complex like a match hitting fumes. One session, the market didn't just dip, it bled. Roughly $1 trillion in equity value vanished in a night, concentrated in the same companies that taught everyone to believe the future always goes up. If you think that is just volatility, you're missing what volatility is for. And here is the scary comparison. The United States runs massive deficits. The interest cost alone has climbed to roughly $1 trillion per year, depending on the month and the debt timing. The Treasury's cash buffer is not some bottomless vault. It is limited, and the government does not get to pause time. It still has to roll debt. It still has to pay obligations. It still has to fund services, contracts, defense, and programs while trying to refinance trillions of dollars when interest rates are high. So when $1 trillion of stock value evaporates in a day, ask yourself what that means in the real economy. It means paper wealth shifts instantly, and it means liquidity and expectations are being repriced at speed. But the real question is not, where did the money go? That question sounds emotional, like you're trying to find a thief in the dark. The real question is, who was positioned to catch it? When markets move this violently, someone is not reacting from zero. Someone already planned, someone already hedged, someone already sold, and now you, the retail investor, are watching from the curb. Now I want you to hold that thought, because we are going to connect it to a concept that sounds abstract until you see how it changes your life. The concept is this: for modern economies, money is less about what you build and more about what you can finance. In the old stories, countries exported goods, and goods meant prosperity. In the modern reality, the global system is dominated by financial claims. Stocks and bonds are not just investments, they are machinery for moving power across borders. Here is a plain example. The United States has a trade deficit. On the surface, that sounds like the country is losing. But a trade deficit is not the same as financial collapse. Why? Because the US exports financial assets to the world. It sells the idea that American claims are the safest place to park money. It sells equities, it sells government bonds, it sells the promise that your money will be treated, serviced, and priced within a system that the world still trusts. That is why the United States can be unprofitable in the goods trade and still remain dominant. So what are you really seeing when you see stock market highs while regular people feel squeezed? You're seeing a world where capital inflows chase financial assets, not necessarily wages or working conditions. You're seeing a system where the winners are the owners of claims and the losers are the people who do not own enough claims to hedge risk. This is why the stock market can rally while you feel broke. It's not a mystery. It is a design outcome of who gets paid from financial instruments and who pays for them through inflation, taxes, and reduced social safety nets. Let's bring this down from skyscraper economics to a human scene, because the numbers don't land until you can picture a life behind them. Imagine a nurse named David, 32 years old, working nights at a hospital in the Midwest. David never missed a mortgage payment. David learned budgeting the way some people learn languages. He has a small retirement account, maybe $10,000 in a broad index fund. He thinks he is playing the long game. Then AI starts changing the work around him. Hospitals adopt software to triage patients. Some administrative roles get cut. Hours get adjusted. Overtime gets reduced. David still shows up, but his disposable income shrinks anyway. Now picture a different David, same age, same stress, different outcome. His roommate got laid off from a call center and started streaming on social media about passive income. The videos look like a freedom lottery, but in reality most creators make zero. Not a little. Zero. The ones who look rich are usually already rich, or they are selling products with inflated promises. The dream is monetized as content, while the viewers are monetized as attention. David, the nurse, is not naive. He understands the value of time. He just doesn't realize how much of his life is being priced by others. And then comes the market shock. Tech stocks gap down. Retirement accounts wobble. David feels the anxiety in his chest. He checks his phone again and again because that is what anxiety does. He tells himself it will rebound. But what he needs to understand is this. A stock drop doesn't automatically mean the system is fair again. Sometimes it just means the system is shifting inventory of winners and losers. Which brings us to the center of today's story, why a model like DeepSeek from China became a market catalyst that US technology giants could not ignore. You were told the world is moving toward AI, and you were told the US leads by years. That story was convenient. It made the future feel predictable, and predictability is comforting when interest rates are uncertain and housing is unaffordable. But then the narrative changed. DeepSeek was discussed in public as an answer. It was framed as a threat. Not because it suddenly arrived out of nowhere, but because the timing of the conversation mattered. According to how markets interpret signals, the most important part is not the technology itself. The most important part is who brings it up, when they bring it up, and what else they did behind the scenes. Here is the brutal truth of market psychology. Executives and insiders have information and incentives. They are not allowed to trade on non-public information, but they are not blind. When the big names begin talking publicly, especially right before or during a major repricing, it's usually because they want to influence expectations. Expectations are currency in financial markets. When expectations change, valuations change. When valuations change, people who are positioned can extract value. And when retail investors scramble to interpret, they become late-stage participants in a move they did not control. So why did influential figures in US tech and finance suddenly echo concerns about Chinese AI progress around the same time? Because it created a storyline that could justify both volatility and capital reallocation. It also let them manage the emotional narrative of investors. The market is uncertain because the enemy is catching up. Therefore, valuations need to adjust. Therefore, the future is still investable. Therefore, the next funding cycle matters. In other words, they are not confessing, they are framing. Now, let's talk about the deep state myth version you may have heard online, where everyone claims this is all a conspiracy. That version is lazy. The better explanation is simpler and colder. It's incentives, it's capital costs, it's how global money moves. And here is the incentive structure that matters in 2026. Global debt is now beyond $300 trillion. That is not a poetic exaggeration. It is a scale where interest payments become a permanent burden. When debt is that large, a small rate change doesn't just affect corporate borrowing, it changes everything: consumer demand, bankruptcy risk, refinancing viability, and asset prices. Central banks like the Fed can say they are stabilizing inflation, but the longer rates stay higher than what borrowers remember from the past, the more the system bleeds slowly. This is why you can feel inflation when the official inflation rate looks better. Your salary may still buy less than it bought in 2019. Energy costs may normalize, but services costs don't instantly reset. Insurance rates can jump, healthcare costs keep rising, and housing is not recovering. It is repricing the lives of an entire generation. People who wanted to buy a home end up renting longer, and renting longer becomes a trap. You build no equity while rent eats the same household budget that would have supported saving. Now connect that to the stock market. When rates are volatile, asset valuations become more sensitive. The market price becomes a tug of war between discounted future profits and the risk of a slowdown. In that tug of war, US technology assets are often treated as the future itself. So when expectations wobble, the valuation wobble becomes violent. That's the visible part. The invisible part is capital allocation. If the largest investors believe they need to keep funding AI and data centers, they must justify it to themselves and to the world. They also need to manage competition anxiety. If China can develop comparable models faster or cheaper, the US must either accelerate or argue that the US still has a structural advantage, and the structural advantage is not only talent, it is hardware, supply chains, energy access, and the ability to scale. Let's go deeper, but in a way that still helps you. A lot of people think AI is mostly software. They imagine it as code. In practice, the cost curve is dominated by compute, chips, graphics processing, and electricity. Data centers are not free. Supply of advanced hardware is not free. Cooling and power are not free. Labor to build, integrate, and maintain infrastructure is not free. So what happens when a competitor appears to deliver strong outputs without requiring the same level of expensive resources? The market doesn't just ask whether the model is good, the market asks whether the cost advantage of the existing leaders is being threatened. And if the cost advantage is threatened, the valuation of companies tied to that advantage becomes vulnerable. This is why the market reaction was not subtle. US AI leaders often trade like monopolies of future productivity. If you remove even part of that monopoly logic, their multiples compress. That is where you saw the trillion-dollar evaporation. And then comes the second twist. In many cycles after a sharp drop, the market recovers quickly. You saw that too, right? If you tried to interpret it as the market overreacted, you're giving yourself the comfort of a simple narrative. But the recovery can happen for a simpler reason. Liquidity returns when big players buy the dip, and big players buy the dip when they can profit from the forced selling of others. Now, let me ask you a rhetorical question, because this is where most people stop thinking. If this was truly only about new technology performance, why did it happen on such a financial timetable? Why do the narratives appear in waves, with executives and media aligned? And why does the stock market behave like a coordinated instrument rather than like a neutral scoreboard? The reason is not that markets are supernatural. The reason is that markets are social systems powered by incentives. When large institutions can move expectations, they can move prices, and when they can move prices, they can move capital. This is where the next layer gets ugly. The AI revolution story is sold to you as inevitability. Jobs will be replaced, the productivity will be massive, you are told to stay calm and learn new skills, but the lived reality in 2026 is that the winners of AI adoption are often the owners of infrastructure and the owners of capital, not the people doing the work. Meanwhile, the labor market doesn't transition smoothly, it lurches. You saw it already with the so-called middle-class decline. People who were never rich are being forced into new precarious arrangements. Some get gig work, some get training, some get nothing. And the training advice from 2020 started sounding like a joke when AI began writing code and answering questions in minutes. It wasn't that you learned the wrong thing, it was that the rules of value changed faster than your personal plan, and this is what you need to understand about the modern economic order. When AI replaces a job, it doesn't just replace a paycheck, it replaces the bargaining position of labor. It increases the speed at which companies can cut costs. And in a world where global debt is already massive, cost cutting becomes survival. So where do the profits go? They go to the capital owners, they go to shareholders, they go to executives, they go into buybacks and balance sheet strategies, and they go into the cycle of financial asset appreciation that you watch on your screen. If you don't own those assets at scale, you watch someone else absorb the benefit. Now we zoom out again, because the story of AI is really a story about industrial revolutions and who controls the next leap. Historically, countries dominated when they controlled crucial technology. The first industrial revolution was fueled by steam power, the second accelerated with electrification and petroleum, the third was computing and the internet. Each era reshaped labor and shifted wealth toward those who arrived early and controlled the infrastructure. Your financial life is still shaped by that old pattern, except now the technology is artificial intelligence and the control points are compute and data and capital markets. The country that builds the compute advantage also builds the financial advantage. It can attract global investment by offering the promise that its assets will grow. It can borrow cheaply. It can issue debt. It can sell equity stakes. It can monetize global savings. This is why investors keep treating U.S. assets as the default landing zone, even when they claim to prefer diversification. They might talk about local markets, but when real money moves, it often moves toward the strongest claim. In 2026, that remains largely the United States for many asset classes, especially because global institutions are used to pricing risk around US dollar liquidity and US financial plumbing. But here is where the cliff rises again. This advantage is not guaranteed forever. If China or another power completes its own industrial leap in AI scaling ahead of US capabilities, capital can redirect. The default landing zone could shift. That risk is priced and unpriced in different moments, and it is one reason the big narratives matter so much. So when US tech giants talk about Chinese progress, they are not only addressing science, they are managing a valuation fear. Will capital flee? Will investors question the long-term dominance story? Will multipliers compress for years instead of days? And now you have to connect something that should be obvious but rarely is explained. The market is not just reacting, it is positioning. Imagine you are an insider with a large stake in a company tied to a trillion-dollar theme. You know the theme may be threatened by a competitor. You also know you still need capital. You can't openly announce panic. You need a narrative that says uncertainty is temporary, that your company still wins, and that the world should keep funding the future. In public, you talk like a strategist. In private, you manage exposure. This is not a cartoon. This is corporate behavior inside incentives. Now let's return to the DeepSeek point, because the most misleading part of the popular discussion is about which model is better. The true market implication is about cost structure and access. If a competitor can develop and run strong AI without requiring as much expensive hardware, that threatens the economics of the entire stack. It could force a repricing of the hardware moat. It could also change who gets to charge what. It could compress margins for cloud providers that rely on high utilization. It could compress the bargaining power of suppliers. But even more important is the psychological effect on investors. When you believe the moat is shrinking, you sell. When you believe the competitor is free or cheap, you reconsider how much you should value the paid incumbents. When you believe the innovation barrier is lower, you question the long-term monopoly premium. Here is an analogy that makes the point without any technical jargon. Suppose you saved for years to buy a diamond ring. You think the ring is exclusive, then you find out someone else is handing out identical rings for free at the same event. You didn't just lose money on the ring, you lost the justification for the price you were willing to pay. Now think about what happens in a stock market when the justification changes. The valuation doesn't slide because investors are stupid. It slides because valuations are based on future expectations. Update the expectation, and the price reroutes instantly. And because this is markets, the reroute is not neutral. It rewards who is fast enough and funded enough to move before the crowd. It punishes who is late. Now, pattern interrupt time, because we need to break the rhythm of explanation before it becomes comfortable. Picture your retirement account as a small raft in a storm. You don't know the storm physics, but you feel the water. Now picture the ocean as the global debt system, and picture the waves as central bank decisions and liquidity conditions. When rates rise, the discount rate rises. Future profits become less valuable today. That pressure hits tech multiples hard. When rates are expected to fall, tech multiples expand. That is why people treat the Fed like a weather god. But in 2026, came down does not mean helped you. The rate path influences asset prices, but your lived inflation experience is sticky. Your rent does not instantly respond to a press conference. Your insurance renewal does not suddenly get affordable because the headline inflation rate improved. Your salary doesn't automatically jump to match the cost you already suffered. So while your raft bounces, you watch the ocean and you think, maybe the storm is over. The market might recover because liquidity comes back for a moment. But your storm damage can remain. And that is exactly why the investor experience can feel fake. The stock market can go up while your purchasing power lags. The system can appear to reward optimism while it quietly drains households through costs, rent, and delayed benefits. Now we have to talk about retirement and how it amplifies everything. In the United States and other aging economies, retirement systems are under strain. Social Security faces funding issues, and the political response has often been delay rather than solution. Pensions are underfunded in many sectors. People are living longer, which is good, but it increases the years you need income. The result is that more people retire later, or they don't retire with dignity. They retire with fear. Fear makes you vulnerable. It makes you chase any asset that might save you, even when the risk is still there. It makes you accept simplistic narratives. It makes you believe the market is a fair game if only you hold long enough. And that is why you must understand the distinction between a market that grows and a society that benefits. The market can grow while your life stagnates because the market is not designed to distribute gains to workers. It distributes gains to owners of capital and to those who can access risk assets. If you do not have enough capital, you are exposed. If you do have capital, you can rotate and hedge. That is the line. Now, let's connect this to AI and the useless class debate you have heard more loudly in recent years. When AI compresses certain types of white-collar work, it doesn't eliminate inequality, it intensifies it. If you can be replaced, your bargaining power drops. If you can't be replaced because you own the platform, your bargaining power rises. In that environment, learning to code becomes insufficient for survival because AI becomes a coworker that can do the coding too quickly. The real protection is not always skill. Sometimes it is ownership, access to capital, and the ability to leverage. That is why narratives about AI progress matter financially. They determine which companies attract capital and which ones get punished. And if you think you can catch every